Well, you just heard Dominic Chu talking to us about the massive amount of stock that companies are trying to buy back in the market. Well, for more on this topic, we're joined by JPMorgan Fund's Chief Market Strategist, David Kelly. David, great to have you back here in the studio. But let me just get back to Dom, because Dom was talking not just about stock buybacks, but what about CEOs and them using their personal money to buy back shares? We're not seeing as big of a bullish sign, are we, on that?
No, Betty. What it comes down to is CEOs, whether or not they're spending their own paychecks to buy back their shares, insider buying of their own company shares. Well, it's stagnant right now. The people at TrimTab's Investment Research said that October volume for CEOs buying back their own stock was about $229 million. Now, the important part about that number, it's the smallest amount so far in any month this year. That's important to note. Also, because the sell to buy ratio, we're going to focus on that sell side, because for every $229 million in October that they actually bought in their own shares, they sold $4.3 billion. So, Betty, that's an interesting sign. So the question right now for somebody like David Kelly is, which way's out here? Is it the stock buyback story, or is it that insiders aren't actually buying their own shares?
David?
Well, I think part of the problem here is that CEOs are very much affected by the general pessimism about the stock market. I mean, it's one thing to make a rational decision about what do you do with all this cash, because companies are accumulating all this cash. But if you actually look at the behavior of individual investors in the month of October and even going into November, despite the fact the market was going up, we've seen steady outflows from equity mutual funds week after week after week. And so what that tells me is that investor sentiment is very negative right now. And I think that is affecting, and I think that's affecting CEOs. I mean, I think it's one thing to say you've got nothing better to do with the money in your own company. It's another thing to actually step up to the plate and invest your money, given your worries about the overall macro picture.
But the fact that companies are buying back more and more of their shares, is that truly a bullish sign, though, David?
I think they almost have to. I mean, the return on cash is essentially zero. We've just had the strongest earnings season in U.S. history. Companies are piling up this cash. They've got to do something with it. They could increase dividends, but that, in many ways, increasing dividends is a more bullish sign than doing stock buybacks. Because stock buybacks, you can always hold at any time. Right. But if you sort of pare back on dividends, that's seen as a much more negative sign. So I think it's because they want something to do with their cash right now.
Well, let's talk about what's driving all of this cash that they have. They're making record profits right now. Companies are getting a lot in terms of the bottom line. But here's the question then: if you look at the earnings that are coming out, we got a lot of big ones coming out this week, especially because retailers very much in focus this time of year. If you look at it, really, Walmart's coming out, JCPenney, Abercrombie, a lot of these retailers. What are you looking for, signs-wise, from these retailers about this past quarter and what's going to be ahead for them in the fourth quarter?
Well, I think we know a lot about the sales patterns already, and what we're seeing is that in some of the more cyclical areas of the economy, we are seeing a bounce. But if you look at chain store sales, frankly, they were a little bit weak in October. And we'll get that in the retail sales report also. I think the most important thing in American businesses is actually their ability to increase margins, because that's really what's spectacular here. Workers have got no bargaining power at all, and so businesses are taking advantage of that to hold down compensation. We've got some good productivity numbers for the third quarter, and that, I think, is translating to margin expansion.
But even in some industries, though, price increases are being absorbed well by consumers, though.
That's right, and we're beginning to see. So, I mean, not only is overall inflation gradually moving up, but more importantly, core inflation. This week we're going to get some numbers of consumer prices. I think the core inflation will now be 2.1% year over year, which is the strongest in a number of years. I think the overall PPI, producer price index, the core there, is going to be up to 3%. So we are seeing a gradual increase in inflation. And I guess that consumers are, putting up with it.
Is there one important piece of economic data this week? There's a lot of data. What's the one that you're keying on the most?
I always look at unemployment claims the most, because the key issue is, are we falling into recession, or are we strengthening here? I think we've had some very encouraging numbers, but I really want to see that unemployment claims number actually drift down from the 400,000 level.
European stocks, I mean, they're all near their session lows right now, and Italy in particular was outpacing. They were ahead of every other market. They were up 2% today. Now they're down 2%. The tide changed very quickly in Europe. Our stocks may follow suit like they have for months now.
David, is this correlation going to continue with us really following what Europe is doing?
Not in the long run, I don't think, because what's going on is the U.S. economy is actually weathering the European storm very well. And so I think we're going to see a sort of splitting off here, where Europe does go into recession and the United States doesn't. And that ought to in the long run cause the stocks to move in different directions.
Right, and it continues to make the U.S. more attractive versus other
absolutely.
assets. Now, David, a lot of people said after October was over, gee, I missed the rally, right? I missed this huge run-up. Are we set up at all for another type of situation like that in this market?
Oh, I think we are. I mean, if you look at price earnings ratios, the earnings have been really good. So the real question is how big are these waves of uncertainty coming from Europe? How much is that? How much will that tend to hit investor sentiment? But if we ever got some calm coming out of Europe, or if we ever realize that we can still grow even if Europe's in trouble, then the market does have room to move higher.
So how do you position, David? If you're out there advising clients, your own funds, shareholders, what exactly is the best course of action right now? Is it safety, or are there certain sectors, certain stocks that you like better than others?
No, I think you first of all have to think about timeframes here. But overall, I would be a little overweight the U.S. And I think if you think that the market's going to go up, then financials and technology will get the biggest bounce out of that. The highest beta areas in this market. So it takes a little bit of nerve, but I think it's very important to realize that just because Europe catches a cold doesn't mean that we're going to get sick.
Are European stocks attractive at all?
They're very cheap, but the problem is that Europe is not dealing with the problems the way it needs to deal with them. I mean, I can't be that optimistic when what they're talking about is austerity, and what they're talking about is recapitalizing the banks, when what they really should be focused on is guaranteeing the sovereign debt and doing fiscal transfers to help these peripheral countries grow. And while they're rowing in exactly the wrong direction, it's hard for me to get optimistic about a short-term solution here.
Okay, David, thank you. Great to see you again. David Kelly from JPMorgan Funds.